Hello, welcome to It's Your Smarter Money with Dr. Laura and Professor Steve. Today we want to talk about 5 end of the year tax moves that you could possibly make in the next couple of weeks. We've been talking to our clients, a lot of you know, over the past month or two about some last minute moves that you could make. However, we want to make sure that we've addressed this with everybody and that if there is anything that we talk about that we've identified and you want help with, that you'll come to see us. So we have 5 tax moves, and then we have a bonus move, and we'd like to talk about that. So the first one is actually that we want you to take a look at what your spending has been this year. You know, many of us have not been going out. We've been either, due to quarantine or lockdowns, whatever. We just simply haven't been spending as much money as we normally would spend in a year. So it's a great opportunity to consider saving more in some tax advantaged ways. So, things like taxable IRAs, Roth IRAs. Steve, you were mentioning something about fully funding the HSA accounts.
That's correct. And by the way, also, I just want to mention that you can, HSA, I don't recall whether you have to fund that by April 15th, but the other things you can fund by April 15th, the IRAs. Your 401k, obviously, you have to make a decision early in the year and make sure that you're having the maximum amount deducted from your salary. I think it's $19,000 this year, and there's a makeup if you're over 50. You got to make sure you've maximized that, especially if you're getting a company match. But even if you don't qualify or you're above the thresholds for IRAs, you may still want to consider doing a non-deductible traditional IRA as well, because at least you'll put more money, have it grow in a tax advantage way. HSA, I think, once again, there are a couple of parameters there. First of all, you have to have a qualifying medical plan through your employer, and that means a plan with a high deductible. And typically employers may give you that option, a couple of plans, one with a low deductible, one with a high deductible that qualifies for you to contribute to an HSA. Now, an HSA is great because it's pre-tax. You can actually use the money for expenses related to healthcare. Actually, for example, if you have a high deductible, you could withdraw some of it to help compensate for that high deductible. But the other key part about it is that when you retire, you can actually treat it as if it was a traditional IRA. So you can put away right now $6,750 per family, actually. So that could be a substantial sum of money by the time you retire if you do it every year.
And I've caught a couple of people that haven't fully funded their HSA. So definitely you want to do that. One other thing that I also have been surprised that people still don't seem to be aware of is just because you don't have earned income doesn't mean you can't contribute to an IRA if you are married. There is this thing called the spousal IRA, where if your spouse is currently earning income, you can put money into a spousal IRA as well. And so we highly recommend that too.
Absolutely. Yep.
The second item is that you may want to consider harvesting some capital losses and rebalancing. You know, some of us are sitting there with investments that we've made and we're waiting for them to come back, and they have significant losses, and now might be a time to consider actually harvesting that loss. You can harvest a loss and you can purchase something else that's a similar type of investment. And if you want to do that, there are some rules around there, the wash rules and so forth.
30-day wash rule.
So you have to be careful with it. We've been doing this for any clients that we've seen any type of losses for, but it's something else to consider.
Yeah, and also you may want to consider actually capturing capital gains if you're in a really, really low capital gains tax bracket. Some of our clients actually are in a 0% capital gains tax bracket. So you may want to capture enough gain in assets that have been are highly appreciated up until you hit that next threshold in capital gains tax. So.
And the 15% tax bracket is pretty darn good also.
Yes, it is.
We expect that it potentially will go up in the future. So if you can take advantage of any of these lower capital gains tax brackets, I think you want to do that. Which actually brings us to our third item, which was to take advantage of your lower income. Some of us have decided maybe we just didn't work that much this year, either because of choice or because of something else happening, or maybe you're even retired. And
Or it could be a gap between the time you retire until you actually start taking Social Security, which could be age 70, and required minimum distributions, which now you're not required to begin those until age 72. So you could have a gap of 5, 6, 7, maybe 8 years even, where your income is quite low.
And so if that's the case, you definitely want to potentially recognize any capital gains, take that off the table. Again, you can repurchase something else that with the funds. And also you might want to consider a Roth conversion, because when we take the traditional IRA and we convert it into a Roth, and we've been doing this for any of our clients that we're aware of that are in this lower tax bracket, we've been helping them do these Roth conversions, because you will recognize income in the year that you do the conversion, but now it's over the tax fence in this beautiful asset that is not going to ever be taxed, nor are the earnings going to be taxed.
And you have
And
no required minimum distributions on a Roth either.
right. I especially like, in fact, we just helped one of our clients who's, they're younger, they're in their 30s, and now they've moved their money into this Roth vehicle that now is going to grow for the next 30, 40 years tax-free. And so the little amount that they moved over, you know, the $100,000 that they moved over is going to be easily, you know, over the course of the years, it's going to double, triple, quadruple, and they're going to have a nice nest egg in a Roth IRA, which is beautiful.
I want to add one caveat. If you don't have a Roth, if you open up a Roth, you have to wait 5 years before you can begin to take the money back out of it.
Right. But a 30-year-old should not be taking money out of
No,
any IRA, because there's the 59.5 penalty as well.
yeah,
So,
that's right.
and by the way, anybody that is in the process of saving for retirement really should not touch those funds.
Yeah, I just want to back up one thing about when we mentioned capital losses. Even if you don't have a lot of capital gains to offset it against, you will be able to carry it forward forever, those losses. Unfortunately, if you don't have any gains in a year, any year, you can still deduct $3,000 against ordinary income, which is a ridiculously low number and has been that way since I think the 1980s. But you won't lose those capital losses. So you're creating I call it a deferred tax asset. That's what you're creating when you do that.
Yep. The fourth strategy, or the fourth thing to think about, is making a gift to charity. If you itemize, one thing you might want to consider is a donor advised fund, or if you are on the brink of, you know, on the borderline of whether you're thinking about itemizing, a donorized fund could be one way to go. And Steve, I don't know if you want to talk about that.
Yeah, well, what happens is if you with the standard deduction, if you which is pretty high right now, it's 24,800 for 2020 and
For married,
25,000.
filing jointly.
Yes, for married. Yeah, that's right. And 25,000 next year. So, for example, if you don't have a lot of deductions but you do want to give to charity, you're not really going to see the advantage of that deduction because of the already high standard deduction. You may instead decide to make one big IRA charitable deduction or contribution of 1 year, and perhaps contribute 50,000. So you see the advantage of that deduction actually, but you may not want to give that all to a charity in a single year. So what you actually do is you create this donor advised fund, which is almost like a trust, and the beneficiaries have to be charities, and each year you can dole out money out of the donor advised trust to charities of your choosing.
So that's one thing you could do. A second thing you could do, if you're in the phase of your life where you are making RMDs, yes, you don't have to make an RMD in 2020. We've been given an RMD holiday. However, you can take your RMD. And if you do, you might want to do what is called a qualified charitable deduction, where you actually you don't take the money. When we contact TD, we don't tell them to send you the money and then you do it. We actually tell TD what charitable organization you want to contribute to. And that way you're actually reducing your taxable RMDs in the future, and you're giving money to the charity of your choice. So you can do that in 2020, even though you don't have to. It is a strategy that you might want to consider. And you know, again, we have 2 weeks to do that. So please call us immediately if you want help with that.
And you know, it makes a lot more sense to do that rather than to deduct money from your IRA, pay taxes on it, and then contribute to a charity. So why not just do it directly and not have to pay the taxes?
Absolutely. Now, some of you might be saying, well, I don't itemize and I'm not in the RMD phase, and so I can't do anything. Well, there is one more thing you could consider. This spring, they did enact something called the CARES Act. And that actually provides temporary help to charities, including allowing any one of us to give, yes, it's a small amount, but it's still something, $300 to a charity of our choice, and we can deduct it from our tax return in 2020. So if you have any charitable inclination at all, that is something that you could take advantage of this year. The fifth item is the idea of possibly considering making a gift to a family member. And one thing, Steve, you might want to talk about again, items with high capital gains might be one way to go.
Yeah, and so what you can do is you can gift a highly appreciated asset to somebody who's in a child or a grandchild who's in a lower tax bracket. And perhaps they can sell that asset at hopefully a much lower tax rate than perhaps you may. You may be in the highest capital gains rate, which is actually 23.8%. Actually, they may be in a 0% capital gains rate up into a certain threshold, or even 15%. Now, it's important to remember when you gift an asset to someone else, your cost basis becomes their cost basis. So the caveat is that if you hold the asset to your death, you may get a step up in basis at your death. So they could receive the asset without without that low cost basis, and have a much higher cost basis. So it's a trade-off, something that needs to be considered carefully.
But if they're in a low enough tax bracket, that might make sense. And
yeah, absolutely. Yep.
But if you are considering that, you immediately contact us, because it does take a little time. We have to open up an account for that, your child or your grandchild, transfer the assets to that child, and then if they want to actually cash them out in 2020, that's additional things that need to get done in 2 weeks. So keep that in mind. Also, I do want to, I hesitate to mention this because I've gotten conflicting information from 2 different tax attorneys, but the information that we're getting is that any gift that you do make in 2020 will be subject to the estate and gift tax exemption amounts of 2020, and which is high, as so many people know. It's bracketed above 11 million. And so they're telling us that there's not going to be a clawback when the estate tax exemptions go back down in 5 years to 5 million, possibly even some people are saying that it may go down as low as 3.5 million. They're saying that it's not going to be clawed back. If you're interested in doing that, we would want to get on the phone with your estate tax attorney and have a conversation about whether this is a good strategic move for you. If you have a larger estate, this could be a possible idea.
Yeah, I think there's some fear on our part that there could be a clawback. We are concerned with that.
Although they're saying no.
Yeah.
Yeah. Okay. And so, drum roll, the bonus move is the idea of a backdoor IRA. And maybe, Steve, you want to talk a little bit about that?
There's actually 2 ways you can do it. The first is you can contribute to an after-tax traditional IRA. So in other words, if your income is so high that you don't qualify for a Roth, or you also don't qualify for a deductible IRA, it could be, for example, for a Roth over $206,000 for a married couple. What you can do is you can actually contribute to a non-deductible traditional IRA, and then a few months later, you want to do it really in the same year, most likely, you can actually convert that into a Roth, believe it or not. You'd have to open up a separate account, which is a Roth IRA, and you just convert that money over. So there is a caveat to this, and Laura reminded me of this. If you have a lot of money in traditional IRAs, they're going to prorate that. So in other words, if you have made pre-tax contributions to a traditional IRA, and you also have had earnings within it, some of that money could actually be taxable because they're going to prorate the total. So it is something to be concerned with. But we do a lot of times see people who have a lot of money in 401ks and not a lot in traditional IRAs. So for people under those circumstances, it may make a lot of sense. Additionally, some employer 401k plans allow you to contribute up to, I think they call it the 315 limit, if I recall, Laura, up to, which I think is around 55,000. So you can contribute 19,000, for example, pre-tax, but you may be able to contribute up to 53,000, including the 19,000, but the difference will be after tax. And some plans allow an in-service distribution, believe it or not. So you could actually each year convert the difference between whatever the 315 limit is and the 19,000 into a Roth each year, actually, believe it or not.
But let me give you an example. So one of the things that we did with one of our clients, the husband was a surgeon contributing to his various 401ks and so forth. But the wife never put any money away for any type of retirement item. So what we did was we said, okay, let's open up a taxable IRA, contribute after tax money because they made way too much money to do a before tax IRA. And then we all opened up two accounts, a traditional IRA and a Roth IRA. The traditional IRA just served as a pass-through. We contributed after tax money to the traditional and then immediately converted it to a Roth IRA. Again, if you're interested in doing something like this, you need to let us know immediately because we don't have a lot of time to do that if you want to recognize an entire transaction in 2020.
I want to mention that we've actually have written a blog on this. It's going to appear on our website roughly the same time as this video has been appears on our YouTube channel. And we'll have a link to this video on our website as well.
So I think we're all ready to say goodbye to 2020. We have a couple things that we can still do to potentially make 2020 a better year than it's been for a lot of us. But we wish you a wonderful holiday and a happy new year. And we're looking forward to seeing everybody in 2021.
Okay.